All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social news producer here at CNBC. Today, we're going to be answering all of your questions about the latest stock market moves and more with CNBC's on-air stocks editor, Bob Pisani. Nice to see you, Bob.
Hi, Catherine. How you doing?
Good. So let's just get started. First question, why did stocks drop so sharply on Monday?
Well, I think the big problem has been a lot of uncertainty about the COVID variants. We've been around talking about this for several weeks, but over the weekend, it kind of got into the public consciousness in a big way. I think probably because a lot of sports people, things happen in the sports world with the Yankees, with the Olympics, and it just sort of all of a sudden permeated people's consciousness. So we saw the big drop on Monday, and I think the issue here is how much does vaccination protect you against the COVID variants? The evidence so far is pretty darn good, but not perfect. So it is possible for you, if you're vaccinated, to get COVID, particularly on a variant. However, the chances are very small. If you do get it, the evidence is overwhelming that the symptoms are mild. There's very few, if any, hospitalizations. And that's the big thing. So in this sense, COVID essentially becomes a disease of the unvaccinated. However, that doesn't mean there's no impact at all. We're trying to figure out what the CEOs are going to be saying about this. The reason the market has rebounded is it's kind of convinced itself that COVID variants may slow the recovery, but it will not derail the recovery. That's a big difference, slow and derail. So far, the commentary from the CEOs has generally been upbeat, particularly from the airline CEOs we've had on. The head of Delta came on, said their bookings are not showing any slide at all. Now, this is an evolving story. We don't know the full answer on this, but so far, the fact that there appears to be, for people who are vaccinated, it's for sure any hospitalization rates are extraordinarily low, and whatever damage occurs if you do get it is very mild. That's helping blunt some of the impact of this of the variant. So I think that's the key story about what happened on Monday.
And kind of going off of that, obviously we saw stocks rebound. And so if COVID is the worry, like we were saying, can you just kind of go over again, what are some of the reasons why you think that the stock market has been holding up so well?
Well, we're at a high now, or historic high. As of right now, we're going to close at an historic high on the S&P 500. And that's the main index to watch. I know people love watching the NASDAQ, but professionals watch the S&P 500. And I think the important thing is there's other things besides COVID that are moving the markets. The two things that really matter are earnings and margins, profit margins. So the earnings for this third quarter and the fourth quarter, which is what Wall Street cares about, it's forward-looking. The stock market's forward-looking, not backward-looking. Those third quarter and fourth quarter numbers keep going up. And there is very clear evidence that this quarter, the second quarter, is the peak of the earnings, but earnings are still going to be going up in the third and fourth quarter. They're not going to be going up as fast, but that's fine. As long as earnings are still going up, that's the most important thing. The second thing is profit margins. What are margins? Well, it's a difference between, what it's costing you to make the goods and the profit, the bottom line that you're making on the bottom. And the profit margins are not dropping. Last quarter, the profit margins on the S&P 500 as a whole, all 500 companies as a whole, was 13%. That's an historic high. And this quarter, it's almost 13% so far. It's been very early. We only have a quarter of the companies reporting. That's pretty darn good. Remember, there's this complete paranoia and worry about high cost of goods, inflation. We have definitely seen some commodity inflation, particularly in things like oil, for example, packaging, those kinds of things. We're hearing that very clearly. And we're also having some wage inflation as well. So, the debate. The Federal Reserve has been saying that this is transitory. The evidence is for things like commodity inflation it is indeed transitory. We see this with lumber prices. They went right through the roof, and in the last month or so, they've been coming down rather dramatically. That's a sign that the Federal Reserve is right. Wage inflation is different, though. Wage inflation is a little stickier. Humans are not pieces of lumber. It's easy if you're a builder to, and you're a lumber supplier to charge more for lumber, but if the price starts going down, he has competition, they're going to drop the prices. Humans are different. If you tell a guy he's making $10 an hour, and then you raise him to $15 an hour, it's a lot harder to tell him he's going to go back to $10 an hour when there's plenty of people out looking for work. Humans don't work that way. Humans aren't pieces of lumber. So the short answer to this whole debate is inflation going to be big? Inflation is probably transitory in certain parts of the economy, like commodity costs, but is probably not so transitory with things like labor costs. And I think that's the right way to look at that. The bottom line, though, is profit margins are holding up. Why? Because companies have pricing power. They've been able to raise prices. Have any of you been out to dinner recently? In the New York region, I can tell you, by my estimates, prices are 15% higher to 20% higher than 2 years ago. Some places more. And I asked the restaurant owners, they say food costs have gone up. They have to pay more for servers. There are dishwashers making $15 an hour right now everywhere. That's cost. So they're passing the prices on because people have money. If you can have a higher cost and pass your prices on, your margins, your profit margins don't go down. And that's what's been happening. Now, this is not, some companies are having problems. Not all of them are able to pass on price increases, but the majority are, at least the ones we have seen so far. And I look at all of them in the S&P 500. And so earnings continuing to go up, profit margins holding up are the reason we are near records. Throw in the story about the COVID variants, slowing, not derailing the economy. There's one final thing you ought to understand, and that's this thing called operating leverage. This is a Wall Street phrase. Operating leverage implies how much more improvement you can get to the bottom line by changing the cost of things in the middle. So I'll give you an example. During COVID, a lot of companies cut costs dramatically. Number one, they cut travel costs. Employees didn't travel. Number two, they cut real estate costs. And number three, they cut jobs. Now, revenues are coming back. Economy's coming back. These companies are making more money. Well, wait a minute. They cut a lot of costs during COVID. So all those costs in the middle, some of them are much lower. So what happens is when your revenues start going up, your top line starts going up, and you have fewer costs in the middle, that top line increase, you get more profit on the bottom. That's called operating leverage. And it's a big thing right now. In the last 2 quarters, all of the earnings reports, the earnings calls, they talk about operating leverage. Now, if you're a cynic, you could say, oh yeah, sure, they fire a bunch of people and then they start making more money. And so they get more profitable once they start making more money because they have fewer people to pay. That's true. But it's a phrase, and it's a very powerful lever for earnings. So it's one of the reasons earnings have been so strong. So there you go, your main reasons. Number one, earnings keep going up. Number two, margins are still strong. Number three, you got operating leverage. And number four, the narrative that COVID is going to maybe slow, but not derail the economy.
Thanks, Bob. So I did a Twitter poll this week to see what our Market Matters fans wanted to hear you talk about most. And they said earnings. So I definitely want to keep diving into this a little bit more. Can you just, again, tell us how things are shaping up so far, what you expect going forward?
Yeah, we're in the middle of earnings season. This is second quarter. Now, remember, the earnings are backward looking. And really, we don't care about the backward numbers. We care about what the companies are going to say in the future, generally about 6 months into the future. So we care about the next 2 quarters. But for the numbers that are coming in, they're still coming in fantastic, and they're beating analyst estimates. This has been a phenomenon that's been going on for 3 or 4 quarters. So we have about 125 companies, about a quarter of the S&P reporting. 90% of the companies are beating the estimates, the consensus estimates, but that's not that important. That happens all the time. What's important is the magnitude, and they're again beating by about 17, 18%. This has been very typical in the last 3 or 4 quarters. That's huge. Historically, analysts are conservative and slightly on the optimistic side. And the companies will normally beat by 3 to 5%. That's very typical. It's a little game that's played. But CEOs perceive correctly that it's good to have a little bit of a beat above what the analysts are thinking and surprise them. 3 to 5 is the historic norm. We're talking now for several quarters, the companies are beating by 15, 16, 17, 18, 20% above, in some cases even more. That's unprecedented. What's happened is the analysts, without really clear guidance from the companies, are underestimating the extent of the economic recovery. In a sense, if you're really a cynic, you can say they're kind of clueless without the companies holding their hand a little more carefully. And the companies have not been providing an awful lot of hand holding in the last year because they don't know what's going on either. So you let them to their own devices, they get the numbers wrong, and they tend to be very conservative. So that's what's been happening. So I'll give you an idea. This is like the mother of all earnings reports, the second quarter. We're talking about earnings that are for the S&P 500 as a whole. Earnings are 76% above what they were in the second quarter of last year. That's crazy. If you give you an idea of what an average yearly earnings increase in the S&P 500 is like 6%, 7%, 8% higher. Historically, I mean, you got to go back, average it out over decades. 76%, I mean, that's just crazy number. And it's been going up. April 1st, it was like 54%. Then July 1st, it was 64%. And now it's 76%. See? Wall Street loves it when the numbers keep going up because it means that their expectations have been wrong and they have to ratchet it up. Now, one problem with the market overall is it's expensive. The average, the multiple on the S&P 500 is about 20, 21. What's a multiple? A multiple it's the PE ratio. It's the price divided by the overall earnings. So if you take the price of the S&P 500 right now and divide it by the earnings estimate, forward earnings estimate, they're using 2022 numbers. And the estimate is somewhere around $210. Some have $220. But take the price of the S&P divided by what you've got right by the earnings estimate, 210, 220, and you're going to get 20 times, 21 times. That's historically very expensive. The average for the S&P multiple is 15 or 16. What is the multiple? A multiple tells you how much I am expecting to pay for $1 of earnings. And that's a good sort of general rule of thumb of where you think the markets are going. When there is an expectation that earnings are going to be rising, the multiple will be higher. When there is expectations that earnings are either topping out or not growing as fast, the multiple will come down. And Wall Street as a group is expecting the multiple to come down because we are in what's called peak of everything. The peak economy, peak economic numbers, the peak earnings. Again, it's not that earnings aren't growing, but they've grown really fast in the last few quarters, and they're still going to grow, but just not as fast. So the rate of change is going to slow down. That would argue historically for a lower multiple. So the street is kind of expecting a lower multiple instead of, it was 22 times forward earnings a few months ago. Now it's 20, and the street is expecting to go down a bit more. There are bulls out there who say, you're all wrong, because the economic expansion is going to be fabulous. In fact, it's going to go on for a year or two. So what camp are you in? Are you in the camp where things are probably going to slow down but still be good, or you're kidding yourself? The economy is going to keep expanding for a long time. A lot depends on COVID. A lot depends on the Fed. Most people believe the Federal Reserve is going to keep rates low for a very long time. I personally in that camp. I think you're all kidding yourself. Think that the Federal Reserve is going to raise interest rates anytime soon. They're certainly not. And even tapering purchases of bonds is controversial. This COVID thing, these variants gets any worse, forget it. The Fed's not going to do anything. They're going to just keep up what they've been doing. So, this is where the Wall Street has debates. What's the course of the economy going to look like? But right now, if you want to look at something to worry about, stock market's expensive. Look at Honeywell today. Honeywell is the #1 industrial to watch because it sells across all asset classes. I mean, Honeywell touches the lives of millions of people because they have a real diverse base that they sell into, not just aerospace, but coatings and safety. There's stuff walk into a store, you're buying Honeywell stuff, I guarantee you. And they reported good earnings today. The guidance was good, just a little bit above expectations, not much. The stock's not doing much, but it's expensive. I mean, this is a really, expensive company right now. Multiples very high on it because people have expectations that the global economy is going to expand. But how much more can it expand? How much better can you get? This is that peak everything story. Sorry to go on about this, Catherine, but it's a real heart of the debate about where the economy is going and is the stock market accurately pricing in the forward earnings and the forward economic outlook. This is what makes a stock market. People agree and don't disagree. And right now, really the market's split between the bulls who think it's going to go on for a long time and those who are more pragmatic who say we're likely hitting a peak right now. There's very few real bears out there. There's very few people predicting recessions anytime soon. And I would find it hard to believe you can support that idea. Anytime in the next year, we're going to see a recession. Absent some other black swan event that comes in, like suddenly a variant that's not effective against the vaccine. So it's a very interesting debate that we're having right now. But this is a pretty remarkable economy.
Yeah, definitely. I think that's a really helpful perspective for understanding where things stand right now. So next, I'm going to switch topics. I'm going to talk about IPOs. Can you tell us about some of the biggest IPOs this summer?
Well, there's good and bad news. The good news is we've had a ton of IPOs, and a lot of companies are going public, and that's good. You want more diversity in the stock market. You want more companies going public. You don't want companies sitting private for long periods because that means the investor doesn't get the advantage of the growth period. Only the people who are sitting there on the stock who own it or the venture capital people, and it's hard to sell shares in the private market. You want a public market. You don't want a company sitting around for 10 or 15 years that's private because the best growth comes in the first few years. If you're going to move in the stock market and participate in that, you want it earlier, not later. So it's great that we're seeing all these companies go private. There's a few troublesome things, though. They're selling at fairly high prices initially. And while we're getting nice first-day pops in a lot of cases, the trading afterwards is not great. So you can look at a few things. Krispy Kreme, their famous name, they're down from their initial offering. It was only a little while ago. We had Mark Wahlberg come on this floor the other day. I met him. It's always nice to meet movie stars. I don't have a lot to say to movie stars. I prefer talking to CEOs, but it's always nice to talk to movie stars or rock stars. He was there. And F45 Fitness went public. Good company. A lot of very ecstatic young people exercising out front of the stock exchange. That's always nice to see. It was kind of exhausting. But that stock's flat too. So here's what's been happening. The first day pop is pretty good for these companies. So the average IPO this year is up 17, 18, 19% from the initial price, up 18, 19%. However, all the money is being made on the first day of trading. After the market, what we call aftermarket, after the first day, the average IPO is actually down. Well, what does this tell you? Well, it tells you the people who are making the money are the people who got the allocation initially. So remember how when an IPO happens, you have an underwriter, you got a Morgan Stanley or a JP Morgan or a Goldman, and they literally underwrite the shares. You're floating 10 million shares, they have them, your Goldman Sachs or Morgan Stanley has them, and they allocate the initial amount of shares to investors. And usually these are institutional investors like mutual funds, and they get the initial allocation. Okay, so now they've got this allocation, and then it starts trading on the first day, and some people are allowed to trade on the first day, and there tends to be a first day pop. Those people, again, they're usually institutions, maybe some hedge funds, they make the money on the first day. But after that, generally haven't this year. And by the way, that means typical CNBC viewers, because they don't get allocations. the day before. They're trading on the first day. So if a stock price is at 14 and opens at 17, and you buy it at 17, and it closes the first day at 16, or next day is at 15, you lost money. Even though the people who bought it at or floated it at 14, and it closes at 16, they made money. But if you buy it at the top at 17 on the first day and it closes at 15, you lost money. And if it's if it is 15 the next day, you still lost money. And that's kind of what's been happening. That does not make me happy. Why? Well, because the average person I talked to was the average CNBC viewer, and that guy or that woman, that they bought it on the first day. They're probably not making as much money. So what does this mean? Well, it tends to tell me that the initial pricing is too high on these. By the way, companies will just say, hey, I'm just listening to my underwriter. The underwriter's job is to get the highest price. So in a sense, they're right. And in another sense, why the hell would the company care? They want the money. They need the money because most of the time they're using it for purposes to expand the business. So why should I price this thing if I have it at 14 and they're telling me I can float it at 14? Why should I price it at 12? Why? Just so some retail person can make some more money? I'm the guy. It's my company. I want more money. So there you go with the tension. I don't have anything against the companies, but I'm on the side of the viewers who are sitting there investing in these things. They're the ones that send me these emails saying, gee, Bob, look at this. Still not making any money on Krispy Kreme. So you get my point there, Catherine. It's good news that there's great companies going public. It's good news that they're making money on the first day. I'd like to see people make a little more money after the first day.
All right, and so you talked a little bit about meeting Mark Wahlberg, but can you tell us about what it's been like on the floor of the stock exchange during these IPOs?
Oh, it's been great. It's been so much, it's a little closer to normal is what it is. It's one of the best things. I've been on the floor since 1997, and people ask me, why have you stayed there so long? I mean, it's like forever. And one of the great things, the reason is because it's just so much damn fun. I mean, I'll ask you guys, what would you do to meet all of your heroes? Anybody you ever wanted to meet, any rock star or movie star or anything like that? I've met, 24 years. Imagine how many bell ringings there are, 24 years. I've met everybody. It's a lot of fun. And most of the times they're not friends of mine. I shake hands, say hello, talk to them for 2 or 3 minutes or 4 minutes, and that's it. But sometimes it becomes even more interesting. I spend a lot more time, but I'm there. Famous people, CEOs mostly is what I talk to. I don't have to do anything. They're just there. I don't have to arrange interviews. They're ringing the bell. There they are. I walk up, say hello. They all generally know who I am if they're CEOs. And it's an interesting job. I'm on the floor with traders. I talk to them. I talk to CEOs. I go out, have drinks with the traders at night. Started to again. Haven't done it in a while, but starting. It's an interesting job. And essentially, it's been on hold for the last 16 months. In the last few weeks, it's come back. First parties on the floor they've had this last week in 16 months. First people allowed on the floor. They were allowing bell ringings, but nobody was allowed on the floor. Now they're allowing people on the floor for IPOs, and you meet the CEOs and you meet their families, and it's fun. It's a big day for most of these people going public. They're sort of become the investor class, and a lot of them are very wealthy. When that bell rings, you can see the calculations going as they're trying to figure out how many shares do I own of this, and wait, it just went at 16, so you can see them doing mental calculations. It's a lot of fun to watch. It's the biggest day of their lives for some of these people. So the floors come alive, and it's one of the reasons I stayed. The IPO process is I think it's probably my favorite single thing to do, is just to walk around and talk to newly minted millionaires and their family. And it's come back now. And believe me, it makes me very, very happy as one of the old guys on the floor now. I guess you can call me that. It makes me happy.
All right, and our last question today, the people want to know, Bob, what's your favorite of your recent rock concert posters?
Rock concert poster. Well, concerts are back. I've been going to a few recently. I'll tell you what I like. I like that they're back. It's nice to go out again. I'm appalled at the prices. I cannot believe the ticket prices I'm seeing. You know, $600 for the Eagles at Madison Square Garden. I mean, seriously, really? But people are paying it because they want to go out. There's a limit to what I'm willing to do. But you were asking about rock posters. I still collect. I've been doing it for a long time. There's a few on the wall behind me. I don't make a lot of acquisitions anymore because I've sort of been doing it so long. But I made one recently. Here's one of my old favorites. This is a very hard poster to find. This is what you call high psychedelia. This is the birth of psychedelia. This is August 1966 at the Fillmore in San Francisco. The Fillmore had just opened a few months before. Bill Graham was running it. The headline act, if you can read this, is 13th Floor Elevators. This is a very famous Texas psychedelic band. In fact, the first Texas psychedelic band run by a crazy guy named Rocky Erickson, very legendary figure in rock history. There is the band here is the Great Society, and another band on the other side, Sop with Camel. But the key thing is this woman here. This is Grace Slick. Grace Slick was the singer for the Great Society. And she was, within a couple months, to leave the Great Society and join a new band called the Jefferson Airplane. And she brought a couple songs with her that became very famous. The most well-known of which was Somebody to Love, which was on the first album. And another song called White Rabbit, which is a psychedelia song, classic psychedelia song. So this is a very famous photograph of her. She was sort of the it girl for in 1966 and 1967, the Summer of Love. She was like the poster child girl for that, and had a big hit with Somebody to Love, and stayed with the Jefferson Airplane. And then when they reformed as the Jefferson Starship, was 73, I think, stayed with them. Still alive, no longer active in music, but she's still alive. This poster exhibits very classic qualities. So they only gave about 2,000 of them out. Graham made them at his own expense and gave them out as people were leaving the concert. So what happened very quickly is, because this is ephemera, these were, you know, kids, college kids, things. They tacked them on the walls, and they were destroyed very quickly. So there's very few original copies that are around, and you can see, it's probably hard to see, but there's tack holes here. Almost all of them have tack holes because people tacked them on the wall. Graham realized that people were collecting these very quickly, and so he authorized reprints, usually 6 months after. Collectors can tell the difference, although in some cases it's very difficult. This one is notoriously difficult. The difference is this one glows under a black light. The other one, the copy doesn't. But there's more of the copies available for some reason because they were handed out at head shops, the reprints they're called. These originals are very, very hard to find. So this is one of my favorites. It's a classic because it has the psychedelia lettering here. And it's got the famous picture of Grace Slick on it. There's not a lot of these early posters that actually had real photographs of people on. So this one, early one of the Grateful Dead, very desirable amongst collectors. It's a kind of it's a fun hobby if you're, you know, interested in the 1960s. So the impact of that this psychedelia had on the visual arts was tremendous, and you can still see it today. Driving down the street, you'll see posters that are, I call them neo-psychedelia. They're imitating essentially what happened, this kind of style in the 1960s. Big, bold colors, bold lettering, sometimes indecipherable lettering. So it's a fun hobby, and you get the when I showed them first time during COVID, when I came home, people just loved it, and I was quite surprised. Who knew there were so many stoners and deadheads watching CNBC? But it's nice to sort of connect to a small group of people that still like talking about the 1960s and things like that. Anyhow, there's a little bit of a detour about some fun hobbies.
Yeah, well, I always love to see your poster collection, and I know our viewers do too. So thank you for sharing that with everyone. So yeah, thank you, Bob, again, and thank you so much to everyone for tuning in for another Market Matters. Have a nice weekend, and we'll see you again in a couple of weeks.
Thanks, everyone. Good questions. Have a good weekend.
Bye.